Kevin checks his phone at 11:43 p.m. Bank app, savings account, $23,400. He stares at it for a second. Then he closes the app and puts his phone face down on the nightstand. Okay, I'm fine. He heard about the war. He watched the news. He saw the oil prices. He felt that little spike of panic when gas hit $3.98 at the Shell on his corner. But Kevin made a decision. A careful, responsible, adult decision. He's going to wait, let things settle down, keep the money where it is, don't touch anything, don't make any moves in a market this volatile. He's seen people blow up their portfolios by reacting too fast. He's not going to be that guy. So he's doing nothing. And that right there is the trap. Because here's what Kevin doesn't know. Right now, tonight, while he sleeps, his $23,400 is losing ground. Not because the stock market crashed, not because he made a bad trade, not because he did anything wrong, because doing nothing is a decision. And in this economic environment, it might be the most expensive decision he's made all year. But here's the part that's genuinely hard to stomach. The trap doesn't feel like a trap. It feels like discipline. It feels like patience. It feels like the smart move. And that's exactly why most Americans are in it right now. Today we're going to look at 5 financial mistakes that millions of Americans are making because of this war. Not out of carelessness, not out of stupidity, but because each one feels like the safe play. Let's start with why your brain is working against you. In 1979, 2 psychologists named Daniel Kahneman and Amos Tversky published a paper that changed how we understand human decision-making. It was called prospect theory. The core finding was this: when people face uncertainty, the fear of losing something hits roughly twice as hard as the pleasure of gaining the same amount. In other words, your brain is wired to feel losses more intensely than gains. But here's what most people miss about prospect theory. It doesn't just explain why people panic sell, it explains why people freeze. When the news is bad, when the headlines are terrifying, when you genuinely don't know what's going to happen next, the default human response is inaction, paralysis, waiting. Because your brain treats movement as risk and stillness as safety. Kahneman and Tversky called this the safety illusion, the feeling that if you don't touch anything, you can't lose anything. And in most areas of life, that's actually reasonable. But personal finance doesn't work that way. In personal finance, money that isn't working is money that's slowly shrinking. Inflation doesn't pause because there's a war. Interest rate risk doesn't care that you're waiting for clarity. Opportunity cost accumulates every single day whether you're paying attention or not. And right now, in March 2026, with oil spiking, inflation forecast to hit 3 to 4%, and the Federal Reserve with its hands tied, the cost of the safety illusion is higher than it's been in years. Here's what makes this particularly frustrating. This isn't about being dumb with money. Kevin isn't dumb. Most people making these mistakes aren't dumb. They're following advice that made sense in 2019. In 2022, maybe even in 2024. But the world changed on February 28th. The Strait of Hormuz, carrying 20% of the world's oil supply, is disrupted. Energy costs are embedded into the price of everything: groceries, shipping, manufacturing, housing. Inflation forecasters are already revising their numbers upward for March and April. And yet, the financial default behavior for most Americans, shaped by years of relatively stable markets, is still don't react, don't move, wait and see. That's the safety illusion tax, the invisible cost you pay not for making the wrong move, but for making no move at all. Most people will never see this bill. It doesn't show up as a line item on your bank statement. It shows up quietly over months as a gap between where your money is and where it could have been. By the end of this video, you're going to be able to see that gap clearly, and you're going to understand exactly how to close it. Let's go through the 5 mistakes, starting with the one Kevin is making right now. Mistake number 1, letting cash sit in a traditional savings account until things calm down. Most people think their savings account is neutral, passive, safe. It is none of those things right now. Here's the math. The national average savings rate at a traditional big bank, Chase, Bank of America, Wells Fargo, is 0.39%. That's not a typo, 0.39. Kevin's $23,400 at 0.39% earns him $91 this year. $91. Now, here's what inflation does to that same $23,400. Before the war, CPI was running at 2.4%. Laura Rosender-Warburton at Macro Policy Perspectives is now forecasting monthly CPI increases of 0.8 to 1%.
9% for March and April alone, driven almost entirely by the oil shock passing through to transportation, food, and housing costs. At a conservative 3% annual inflation, Kevin's $23,400 needs to earn at least $702 this year just to break even in real terms. He's earning $91. That's a real money loss of $611, not because of a bad trade, not because of market volatility, because of the bank he chose and the decision to wait. But here's where it gets worse. High-yield savings accounts are currently offering 4.50 to 5.00% APY. Ally Bank, Marcus by Goldman Sachs, SoFi, Newtek. These are FDIC-insured accounts. They carry the same federal protection as your Chase account. $23,400 at 4.75% earns $1,111.50 this year. The difference between Kevin's bank and one of those accounts? $1,020 per year. Not from investing, not from taking any risk, just from where the money lives. Most people have never moved their savings account because it's boring and slightly inconvenient. That inconvenience is costing them over $1,000 a year. The war didn't create this problem, but it made the problem significantly more expensive. CFP Valerie Rivera, founder of First Gen Wealth in Chicago, said it clearly. Moving 100% to cash may feel safe, but it introduces interest rate risk, inflation risk, and opportunity cost all at once. There is no risk-free option. Even being too conservative is a risk. Your savings account is a slow leak. The war just made it faster. Mistake number 2. Selling investments because the market feels too risky right now. Since February 28th, a lot of people have done something that feels completely logical. They looked at their 401k, saw the red numbers, felt their stomach drop, and moved everything to cash or bonds. It feels like protecting yourself. It feels like getting ahead of the crash. Here's what the data actually shows. Hartford Funds analyzed the S&P 500 over a 30-year period through 2024. If you missed just the 10 best days of the market during that entire period, 10 days out of over 10,000, your total return was cut in half. 10 days, half your returns. Gone. And when do the best recovery days usually happen? Almost always in the middle of the worst stretches, when the news is the most terrifying, when it feels the most dangerous to be invested. The investors who panic sold in February and March of 2020, when COVID was shutting down the global economy, missed one of the fastest recoveries in market history. The S&P 500 went from its low in March 2020 to a new all-time high in just 5 months. Now let's look at actual war data. Invesco and researchers Caldara and Iacoviello built a geopolitical risk index tracking the S&P 500's return in the 12 months after the peak fear point of major conflicts. The numbers are striking. After the Gulf War, S&P 500 up 22.6%. After Iraq 2003, up 35%. After the Israel-Hamas conflict in 2023, up 34.1%. The pattern is consistent. Geopolitical fear peaks, the market looks terrifying, most people run, and 12 months later, the market is significantly higher. But here's where most people miss it. You only capture those gains if you're still in. The moment you sell in panic, you've locked in the loss, and the moment the market recovers, you're sitting in cash trying to figure out when it's safe to get back in. There is no signal. There is no all clear. Most people get back in after the recovery has already happened, buying high after selling low. This is not a criticism. It's biology. Your brain is doing exactly what Kahneman and Tversky described. It's trying to protect you from loss. But in long-term investing, that instinct is your enemy. The people who panic in wartime are the people who pay for the recovery of the people who stayed.
Mistake number 3. Trusting that your 60-40 portfolio is still protecting you. For decades, the 60-40 portfolio was the standard answer to managing risk. 60% stocks, 40% bonds. The logic was clean. When stocks fall, bonds rise. The two assets move in opposite directions, balancing out the volatility. That logic worked beautifully for about 40 years, and then it stopped working. During 2022's inflation shock, stocks and bonds fell simultaneously. The 60-40 portfolio had its worst year since 1937, down roughly 17%. That wasn't supposed to happen. The entire model assumed bonds would cushion the blow. They didn't. And right now, Bloomberg is identifying the same risk. The biggest economic threat from this war is stagflation. That means high inflation and slowing growth at the same time. In a stagflation environment, the Federal Reserve can't cut rates to support the economy without making inflation worse. The VIX, the market's volatility fear index, hit 27.30 on March 3rd, its highest level in 3 months, with both stocks and bonds under pressure simultaneously. The 60-40 model assumes a world where inflation is low and the Fed has room to maneuver. That is not the world we are in right now. Most people with a target date fund or a standard retirement allocation are operating on autopilot, assuming the system is working. Some of them haven't looked at their actual asset mix in years. That isn't patience, that's just not paying attention. This doesn't mean abandon your retirement account. It means understand what you actually own and whether it was designed for the economic environment you're actually living in. Your grandparents' portfolio wasn't built for a war-driven oil shock. Mistake number 4. Buying gold at all-time highs because it feels like protection. Let's talk about Sandra. Sandra is 52. She's been watching the news. She saw gold hit $5,300 an ounce and read 3 articles calling it the ultimate safe haven. She bought GLD, the gold ETF, in early March 2026, right as gold was making headlines. Here's the thing about Sandra. She's not wrong that gold is a legitimate hedge. Gold has a real role in a diversified portfolio during inflationary periods. But Sandra doesn't own a small strategic gold position as part of a broader plan. Sandra bought gold because she was scared, at all-time highs, without a plan for how much to own or when to exit. We know exactly what this looks like historically. In March 2022, gold spiked on the Russia-Ukraine war. It hit $2,050 an ounce as fear peaked. Investors rushed in. Then, over the following 8 months, gold dropped more than 20% as the initial panic faded and the dollar strengthened. The people who bought gold at the peak of that fear cycle didn't get protection. They got a 20% loss while they waited for the safe haven to save them. Gold at all-time highs is not a buy signal. It is a fear signal. It tells you that a lot of scared money has already moved into gold, which means the easy gains have already happened, which means the risk-reward for buying today is significantly worse than it was 6 months ago. A reasonable gold allocation for most investors is somewhere between 5 and 10% of a portfolio, held as a long-term hedge, not as a panic reaction to a single news event. If you're thinking about piling into gold right now because of the Iran war, you're probably the last person at the party. Gold at all-time highs is not a buy signal. It is a fear signal. Mistake number 5, ignoring the silent tax of opportunity cost. This is the most invisible mistake of all 5, and it might be the most expensive. Opportunity cost is the money you don't make because of where you chose to put your money instead. It doesn't feel like a loss. There's no notification on your phone. Your account balance doesn't go down. You just quietly fail to accumulate the money you could have had. Let's make this concrete. Kevin has $23,400. It's been sitting at 0.39% for 2 years. Over those 2 years, he earned about $182 in interest. If that same $23,400 had been in a high-yield savings account at 4.75% for 2 years, still FDIC insured, still completely liquid, available anytime, he would have earned approximately $2,289. The difference? $2,107, not from investing, not from taking any risk, from a 15-minute task he never got around to. Now extend that 5 years. $23,400 at 0.39% for 5 years, approximately $455 total. $23,400 at 4.75% for 5 years, approximately $6,167 total. The gap? $5,712. Kevin didn't lose $5,712, he just never had it. And that's what makes opportunity costs so dangerous. It's invisible. It never shows up as a line item. It never triggers an alert. You just end up 5 years older with $5,712 less than you could have had, and no clear moment where anything went wrong. The war didn't create this situation, but the war just made the cost of doing nothing significantly more visible, because inflation is now actively shrinking the purchasing power of every idle dollar, while the interest rate environment is offering real returns to anyone who moves. Most people won't move, because moving requires a decision, and decisions feel riskier than stillness. That's the safety illusion tax, and you've been paying it quietly for years. You're not playing it safe. You're donating thousands of dollars to your bank. Here's the part nobody talks about. None of what we just covered is an accident. The financial system was not designed to make these 5 mistakes obvious to you. It was designed, structurally, deliberately, to make them as invisible as possible. Your bank doesn't send you an email that says, "Hey, just so you know, there are savings accounts paying 12 times more than what we're giving you. Want to move your money?" They don't say that because your idle cash is one of the most profitable assets your bank owns. Banks collect your deposits at 0.39% and lend them out at 7, 8, 9%. The spread between what they pay you and what they charge borrowers is the engine of their business model. They bank, literally, on your inertia. Financial media doesn't help either. It was built for engagement, not clarity. War headlines, volatility alerts, breaking news tickers. Every piece of breathless coverage that sends you reaching for your phone in a panic is content that was designed to keep you reactive, not informed. Reactive. Because reactive viewers watch more. Reactive viewers click more. Reactive viewers are far less likely to sit down, calmly run the math, and make a rational decision. The news cycle around this war has been extraordinary, and some of it is genuinely important. The Strait of Hormuz carrying 20% of the world's oil supply is not a minor story. But the constant alarm, the wall-to-wall coverage engineered to keep your cortisol elevated, is not designed to help you make better financial decisions. It's designed to keep you watching. And while you're watching, your money sits still. The system doesn't need you to make a catastrophically bad decision. It doesn't need you to blow up your portfolio. It just needs you to do nothing. Because nothing is the most profitable outcome for the bank. Nothing is the most engaging outcome for the media. Nothing costs you thousands of dollars over years, quietly, with no drama, with no single moment where everything went visibly wrong. That's not an accident. That's a feature. And here's the thing. This is not your fault. You were never taught this in school. Nobody handed you a document that explained the gap between savings rates. Nobody told you that inaction in inflationary environments is an active financial decision with real costs. You did what made sense based on what you knew. Now you know more. So let's talk about what you can actually do. Not a 47-step financial overhaul, not a complete portfolio rebuild. 5 specific actions, one for each mistake, that you can start this week. Action 1. Open a browser tab right now and look up the current APY on your savings account. If it's below 4%, you're leaving real money on the table. Compare it against Ally Bank, Marcus by Goldman Sachs, SoFi, or Newtek. All FDIC insured, all accessible within 1 to 3 business days. The move takes about 15 minutes. The gain is potentially thousands of dollars over the next few years.
Action 2. If you've already sold investments in the last 2 weeks because of the war, don't spiral. Don't compound one reactive decision with a second one. The question now isn't whether selling was the right call. The question is what the data says about getting back in. We went through the numbers. Historically, 12 months after peak geopolitical fear, markets are substantially higher. You get to decide what to do with that information. Action 3. Pull up your 401k or brokerage account and look at your actual allocation, not the one you set up 3 years ago, the one that exists right now. Are stocks and bonds still moving the way your model assumed? If your target date fund is set for 2040 or later, history suggests staying the course matters more than reacting to a single conflict. But if you haven't looked in 18 months, now is a reasonable time to look. Action 4. If you're considering adding gold, cap it at 5 to 10% of your total portfolio, no more. And don't buy it because you're scared. Buy it because it fits a deliberate allocation strategy you've thought through. Panic buying at all-time highs is not a hedge, it's just fear wearing a different outfit. Action 5. Run the opportunity cost number on your own savings. Take your current balance, multiply it by 0.0039 and write down the result. That's your annual interest at a traditional bank. Then multiply by 0.0475. That's what a high-yield account would pay you. The gap between those two numbers is what your inertia costs you every year. Make it real. Numbers on paper have a way of creating movement that headlines don't. Here's the honest truth about this moment. Nobody knows exactly how long the conflict in Iran will last. Nobody knows exactly where oil prices will land in 6 months. Nobody knows with certainty what the Fed will do in March or May or July. What we do know is this: the way you respond to uncertainty matters more than the uncertainty itself. The people who make it through periods like this aren't the ones who predicted everything correctly. They're the ones who kept asking the right questions, kept running the real math, and kept making small, deliberate moves instead of waiting for the all-clear signal that never actually comes. The all-clear never comes, but clarity, that you can build yourself. You now have the framework. If this video helped you see something differently, share it with one person in your life who's currently doing nothing with their money because they're waiting for things to calm down. They're probably Kevin, and Kevin needs to see this. Thanks for watching. I'll see you in the next one.